The oil
Professor,
prices went up relative to everything else, but the general price level never changed much in Japan
yeah,
because the money
Professor,
supply never
I
changed
gotta admit,
much.
Professor, I'm a good student. I agree with everything you just said. You misunderstood my point. I'm not saying that rising oil prices cause inflation. They don't. But what they do is factor into the CPI, which measures inflation. So what I'm saying is one of the main reasons that the CPI went down from up 9% year over year to up 3% was because you had a pullback in commodity prices. And so that reflects in that. But the overall rise in oil and other commodity prices that is going to continue in 2024 and beyond is inflation.
Well,
Inflation is what's
now
causing commodity
you
prices to
can't have
rise,
it
not
both
the other way
ways.
around.
You can't have it both ways.
I'm not having it both ways.
No,
Yeah,
you
I'm
are.
not.
Let me give you another
No, I'm
lesson.
not.
You are. You're absolutely wrong on this, and let me tell you why.
We're pleased to present to you a panel between two favorites in the show, Professor Steve Hanke, Professor of Applied Economics at Johns Hopkins University, and Peter Schiff, Chief Market Strategist of Euro-Pacific Asset Management and Chairman of Schiff Gold. He's also the author of several books, including Crash Proof 2.0, How to Profit from the Economic Collapse. We'll be discussing their outlook on inflation, economic growth, monetary policy. Welcome both, Peter and Professor Hanke. Good to see you.
Thanks for inviting us on.
Yeah, great to see you, and great to see Peter also.
Yes.
Straight from Puerto Rico.
Well, gentlemen, you're both titans in your respective spaces. Feel free to converse with each other. I'm just here to facilitate the conversation. Let's begin with the topic of inflation, as I believe both of you have differing views on where inflation may be headed. Peter, I'll start with you. You recently tweeted that the longer the Fed keeps interest rates at current levels, the larger federal budget deficits grow. Rising deficit spending adds to the upward pressures on consumer prices. This pressure will increase when rising deficits lead to a weaker dollar. Higher rates equals higher inflation. Peter, can you walk us through the transmission mechanism here? Why will higher interest rates necessarily lead to higher consumer prices? And ultimately, where do you see inflation headed?
Yeah, well, first of all, too, remember, inflation is not just an expansion of the money supply, but also the supply of credit, because consumers could buy using credit just as if they had actual cash. And that's what's been going on. Even though the Fed has raised interest rates, people keep on borrowing and spending. Household debt at record highs, credit card debt at record highs, government debt, deficits running at a record pace. So the Fed has really had no effect on slowing down credit growth, and all of this is fueling inflation. But the box that the Fed is now in is, if raising interest rates is their tool for fighting inflation, apart from the fact that interest rates are also a cost that businesses have to pass on to their customers, just like rents or raw materials or labor or any other cost. The problem for the government is, as interest rates go up, budget deficits automatically go up, because it costs the U.S. government a lot more money to refinance all the maturing debt, plus to finance all the new debt. And to the extent that that increase in interest rates dampens the economy, it also leads to a reduction in tax revenue, an increase in other government spending. And so the Fed ends up driving the budget deficits even higher. And that ultimately is the source of inflation, because it's the Federal Reserve that ends up monetizing all that government debt. That is, what's driving the problem. And I think ultimately, as our budget deficits are exploding, it's going to cause a big loss of confidence in the dollar and U.S. Treasuries. And so as the dollar starts to fall, that puts even more upward pressure on consumer prices, because the dollar now has less value internationally. And so, everything that you buy is going to be more expensive.
Okay. Professor Hanke, I'll let you answer the same question, and then I'll give Peter a chance to respond. What is your view on inflation? Walk us through your thesis of how the money supply affects inflation.
Well, the money supply dominates, and since the money supply has been contracting for quite some time, actually since March of 2022, it's contracted by a little over 4%, which is not totally unprecedented, but almost completely unprecedented. We've only had 4 contractions ever in the money supply since the Fed was established in 1913. And we have to go way back to the 1940s to even find the first contraction. 48, 49, it contracted. Then we go back into the 30s, 37, 38, it contracted. And then, of course, a huge contraction in 29, 33. That was a Great Depression. And we had another contraction in 2022. So they're rare, and we haven't seen them for a long time. And every time they've occurred in the past, we not only have had a recession, actually one depression out of the four that I mentioned. The other three, we had pretty good recessions. So that's an economic slowdown, which we'd expect from the slowing of the money supply and contraction of the money supply. But also remember that there's a sequence of things that happen after there's a significant change in the money supply. The first thing, asset prices change. And then with another longer lag, the economic activity changes course. And then with the longest lag, inflation. And inflation, John Greenwood and I anticipate that it's going to continue to go down, even though we've had a little stickiness here the last 3 months. And we'll go down to the target level, or if not below, by probably not the target now by the end of the year. With these last 3 months of sticky inflation, it's probably going to push that 2% level off until sometime early in 2025. But that's all really baked in the cake. It doesn't matter what the Fed's doing now. It's already happened because monetary policy has an effect on things with very long and very, very highly variable lags. So that's more or less my picture. It's a little bit different than what Peter was talking about, inflation going up.
Let me ask you a question, Professor, though. You're talking about the recent decline in money supply, but what about the unprecedented expansion that occurred prior to that? How much did money supply grow before it began to contract?
Well, it was totally unprecedented, Peter. Actually, the increase that we saw in February of 2021, the money supply actually was increasing at a 27% year-over-year rate. That's the highest in history, and as a result of this huge surge in the money supply after the pandemic hit in early 2020, we had a massive overhang of excess cash balances. And that's now actually been drained out of the system. It just was drained out of the system.
But wasn't the money supply also expanding for many, many years before that?
Oh, very small, very slow rates. The golden growth in the money supply, Hanke's golden growth rate's about 6% per year. And that's consistent with hitting a 2% inflation target. So if it was growing at 6% per year, measured by M2, the broad money measure, you feed the real growth in the economy, you feed the natural increase in the demand for cash balances, and that increases normally about 1.7% per year, more or less 2%. And the potential growth rate in the economy is more or less 2%. And the inflation target is 2%. So 2 plus 2 plus 2 is about 6%. That keeps you on an even keel. And that's why we had what we had in the 1990s, by the way.
Well,
that's what was going on in the 1990s. Go ahead.
Is it impossible, though, that there was enough inflation, I think, in the pipeline before money supply started to contract, although the entire time credit continued to grow, which is obviously part of the real money supply, is what people can use with credit. But what if there is a big backlog of inflation that hasn't even fully worked its way into the price structure yet? So I don't know that we've even caught up to the inflation that was created before we saw the contraction in money supply. Well, if credit continued to expand the entire time, I don't see how the upward pressure on prices is going to abate.
Well, you've got to, if you look at the money supply, you're incorporating the effects of credit. So I'm looking, I think, at what the relevant measure is. Money dominates, And back to this deficit thing, we have a little. So there wasn't. You're making a conjecture that there was a excess amount of cash balances that were out there beforehand. That's not true. And then you can measure that by just dividing GDP, nominal GDP, into the money supply M2, and that gives you the cash balance. It's the reciprocal of velocity. And if you do that, there wasn't any excess. So what you're saying is just not correct. And if you look at the deficit too, deficits don't necessarily cause inflation. Money dominates. It's all about the money supply. Now, deficits you mentioned the word monetize. If the deficit was monetized, and therefore the Fed is buying treasury securities from the non-bank public, in that case, obviously the money supply goes up and inflation is going to go up.
That's exactly what it did with quantitative easing. I mean, that was what it was. They bought $8 trillion worth of treasuries and mortgage-backed securities.
That's what happened. The last quantitative easing, not the first. The post-Lehman crash that we had, it did not end up in inflation, and many people are confused about that. We had quantitative easing, and the Fed's balance sheet exploded, and a lot of people said, "Oh, we're going to have a tremendous amount of inflation because of this." Well, the Fed's contribution to what I call the state money contribution to the money supply M2 was exploding, but at that same time, remember, the banks were bad. Dodd-Frank would put a noose around their neck. Basel III capital requirements put a noose around their neck. And the bank contribution, the most important elephant in the room are banks. And you keep talking about credit. It's bank credit. That's who makes the money supply. Most of the money supply is actually created by the commercial banking system.
Well, and certainly have a lot more.
After Lehman collapsed, their contribution went negative because of huge bank regulations coming in from Dodd-Frank, as well as on the top of that, you had Basel III coming, and so that affected it. Now, the deficit, let's just be clear about this. To clarify this, the best way to look at it is look at Japan. Japan has since 1990 had a massive fiscal deficit, and they have no inflation. And the reason they have no inflation is because the money supply is growing way below my golden growth rate for Japan is about 5% growth, and it's been growing about 2%.
Well, first of all, we have a lot more debt than we had when Lehman failed. I mean, debt has exploded, and we didn't get all that QE for free. I think we did create inflation. A lot of it went into financial assets temporarily. I think there has been a big lag. And I also don't think the government measures inflation properly, so it's hard to tell exactly the effects that inflation has had on prices when your CPI is flawed by design and doesn't really capture the degree to which prices are rising. But I also disagree that Japan doesn't have an inflation problem. They do. Even by their own measures, it's running 2-3%. But again, I'm sure that there's a lot of flaws in the way the Japanese measure it. But again, you have to look at what might have happened, because you can't just look at prices going up. Maybe prices should have gone down. Maybe without the government creation of inflation, consumers would have benefited from lower prices. And they didn't get lower prices. They were robbed of those price declines by the government that created inflation. And so maybe instead of buying things for 2 or 3% less, they ended up spending 2 or 3% more. But that's 5 or 6% inflation, not 2%.
Yeah, but Peter, you're redefining everything here, which is just a mass of confusion.
No, I'm not. I'm sticking to
there was no inflation essentially in Japan by any traditional measure since 1990.
How are you defining inflation?
The most recent numbers we have, it's ticked up just a little bit.
But how are you defining inflation?
I'm defining it the same way the Bank of Japan defines it.
I'm just asking how you define it, not how a government defines it, because I think governments misdefine it. The governments want the public to believe that inflation is created by outside factors, by greedy corporations, by economic growth, by employment, by all sorts of things. But if you go back to an older
That's the way
dictionary,
they do. That's not the way you haven't read some of the work that John Greenwood and I have done as monetarists. There's only one thing that causes inflation, and that's changes in the money supply.
But that doesn't just
look,
cause inflation. That is inflation. What is being inflated is the money supply. You go back and get an old dictionary, even in the 70s. You get a dictionary, Webster's dictionary, look up inflation, and it says an expansion of the money supply, and it's also money and credit. Rising prices are a result, a consequence of inflation. They are not inflation, and they do not cause inflation. They are a byproduct of inflation.
Okay, we agree that you're just spitting out. Forget the dictionary. Go to Ludwig von Mises or any good Austrian, and you'll find the definition. You start by changes in the money supply. And that leads to changes in prices and the general price level.
Correct.
And right now we're in a situation where many people talk, including you, about stagflation. And the real dean of that, the expert on it, is Gottfried von Habler, a great Austrian economist. This is his book I'm holding up right now. That's a little Bible on stagflation and what causes it. And the inflation part of it is caused by changes in the money supply. And as Habler says, and I'm reading off of Habler right now, and Habler indicates that no significant inflation has ever occurred in which the price level, that is, went up by 4% or more for more than 2 years if there wasn't, as he said, a significant increase in the change in the money supply prior to that.
Yeah, well, we certainly have had a big increase in the money supply, but I think the future increase is going to be greater because we're heading towards a fiscal explosion. Interest on the national debt is now about 1.1 trillion a year. By next year, it's going to be 2 trillion.
You're looking into a crystal ball. I'm looking in the reality of what's actually happened.
All right,
you don't need a crystal ball to do this math.
No, it isn't math. It isn't. You're wrong. And you're wrong. Just look at Japan. Japan has had a massive increase in their debt and in their fiscal deficits.
Okay,
you don't think that's a problem?
It's the highest ratio in the world, and they have not had inflation because they've not increased the money supply adequately. They've had a deficiency in the growth of the money supply. That's why they have never had an inflation problem since 1990.
They have one now just with their own statistics, but look what's happening to the yen. I mean, the yen is almost at 160 to the dollar. Of course, it's falling against all currencies. Prices are going up. I mean, how can they not have an inflation problem?
Let me just ask Peter, just to follow up on what you said, and we'll go one at a time here. Peter, you just said that the Fed is likely to expand their monetary policy once again because of the deficit problem, right? Are you suggesting we're going to get QE again? Are you suggesting that they're going to?
Yeah, I think the most recent announcement by the Fed that they're tapering their quantitative tightening program. They're going down from 95 billion a month to 60 billion. This is the first step in a return to quantitative easing, because the Fed is going to have to choose between government defaulting on its obligations or slashing spending on Social Security, Medicare, government pensions, or monetizing that debt, because there is no way that the government can finance it at current interest rates. And the only way they could get interest rates down really is to go back to QE. They're going to have to start buying more government bonds to artificially suppress rates. And so inflation is going to explode. I mean, those are the choices. We can have default and deflation, or we can print and have massive inflation. But from a political perspective, I think that's the only viable choice that the Fed is going to make. And even if Powell didn't want to make it, he's going to be under tremendous pressure to make it by the Biden administration or whatever administration, even the Trump administration would do that. Nobody wants to see government spending cut dramatically. Nobody wants the U.S. to have to honestly default on its debt.
Could they just raise taxes, Peter?
Monetize it.
Couldn't they just raise taxes, Peter?
On who? I mean, if they raise taxes on the rich who are already paying a tremendous amount of taxes, I don't know how much additional revenue they're likely to get. In fact, they may even lose revenue depending on how they do it. What we need is consumption-based taxes, like a national sales tax or a higher payroll tax. But no one's going to vote for that. I mean, no one's going to tax the middle class. And the middle class is already broke. People have no savings. They're maxed out on credit card debt. And they're working 2 or 3 jobs. How are you going to tell middle-class voters that on top of all this pain, we're going to significantly raise your taxes? I mean, it's just politically, it's a non-starter. So the path of least resistance is to print, right? And then they're going to blame the inflation on somebody else, right? Speculators, greedy businessmen, Putin, OPEC. I mean, they always point fingers because they've redefined inflation as rising prices. And so the government doesn't raise prices. They point to all the people who are raising prices and they blame them for the inflation.
Okay, perfect. Professor Hanke, same question to you. What is a likely course of monetary policy? And do you agree with Peter that more easing is to come, which would in theory cause inflation?
Again, we can talk about possible scenarios, but I'm not in the crystal ball business. And if we have an unsustainable deficit right now, everyone concludes this, even the nonpartisan Congressional Budget Office concludes this is not sustainable. We cannot continue with the current structure that we have right now. So how do you change that? Well, one thing you can do is tax. And there are 2 ways to tax. You can have an inflation tax, and that would be by monetizing a big chunk of the debt. That's possible. And you can have direct taxes where Peter and I get whacked with an increasing tax bill. And so do other Americans.
I'm in Puerto Rico, so I'm immune.
Well, okay. Well, you've taken care. You've been vaccinated. So the question is, what are they going to do? The deficit is not sustainable. Everyone agrees. They can tax to close the deficit, and that taxing will be either an inflation tax or increases in direct taxation. The other thing they could do is control government spending and put a cap on spending. So those are the only 3 possibilities.
And you don't need a crystal ball to know which one they're going to pick, because there's no precedent for cutting spending. There's no precedent for raising taxes on them. I mean, they have raised taxes in the past, but they're not going to do it now.
Hang on. You're making a lot of statements here that are generalities that are not precise. And one of them is you can't cut government spending. And Bill Clinton was the most conservative fiscalist we've ever had. And Clinton did cut government spending as a percent of GDP by a much greater percentage than any other president since World War II. Eisenhower did a little bit, and Reagan did a little bit by the end of the second term of Reagan.
Right, but they didn't cut Social Security. They didn't cut Medicare. That's what needs to be cut now.
Okay, you're changing the topic. I'm talking about the budget. I refuse.
I know, but I'm talking about what needs to be cut in order to make a difference.
I'm talking about what Clinton cut. Let's talk about Bill Clinton for a minute. You made a statement, and the statement was incorrect. You said you can't cut spending. Clinton did cut it.
It still went up.
We had a definite, significant reduction in government spending as a proportion of GDP. The private sector became bigger under Clinton, and the government sector became smaller under Clinton. And we had Newt Gingrich in the Congress, and we had Bill Clinton in the White House, and these cuts occurred. And as a result, the last 2 terms, the last 2 years of Clinton's second term, we actually had budget surpluses, and everybody was panicked that the government wouldn't be putting out any treasuries. There wouldn't be any liquidity in the market, and we'd have chaos on Wall Street. Remember that?
I remember those statements, and I was laughing what a great problem that would be to have, but I knew that it wasn't going to happen because these projections were pie in the sky. But, even the years of the surpluses, those 1 or 2 years, those were accounting surpluses. The national debt itself went up each year that we supposedly had a surplus. So a lot of it is because the government just doesn't count some of the spending. They claim it's off budget, and so they can pretend they have a surplus. But I will grant you that fiscally, under the combination of Clinton Gingrich, we didn't do nearly as bad as we did under Bush Jr. and under Obama and under Trump and under Biden. But I don't see any realistic return to any kind of fiscal responsibility, especially given the gravity of the problem now that is so much bigger than it was when Clinton was president. And the fact that now, in order to have any meaningful success, you're going to have to gore all the sacred cows. You're going to have to make cuts to Social Security, Medicare, government pensions now, not in the future. We're not going to tell people that in the future they're going to get their Social Security.
Let me summarize what you're saying. What you're saying is very simple. You say we have a big fiscal deficit problem. Hanke and Peter agree. We have a big problem. There are only two ways to solve that from the fiscal point of view, and that is, one, you cut government spending. You say that's impossible. It's never happened before. I say, well, it did happen under Clinton and Gingrich. They did get things under control. And I also say, if you had a constitutional convention under Article 5, you could change the Constitution and put in a Swiss debt brake. So there are things that could be done. You don't think they're going to be done to tap the brake on government spending. So, okay, fine. So then what's left? You can tax, and there are only two ways to tax to close it, and that is increasing direct taxes, and Peter says, no, that's not going to happen. And you're left with the only thing left, and that's an inflation tax. That's the taxonomy of what we're talking about here.
That is my point. And also, what makes it so hard to cut spending now is the biggest line item in the budget next year is going to be interest on the national debt. And you can't cut that unless you're going to default. So if you take interest on the national debt off the table.
This has exploded. It's higher than defense spending is right now.
And next year it'll be higher than Social Security and Medicare. The national debt is almost growing by $1.25 trillion. It's exponential.
This is all because of inappropriate, disastrous monetary policy by the Fed.
I agree.
That has created the problem that we are in now. It's not on the fiscal side, Peter, as you imply. It is because of the Fed and the monetary side.
Well, I agree. The Fed
monetary policy dominates.
The Fed enabled the deficit spending. The Fed should have been more independent. They should have had much higher interest rates. They never should have done quantitative easing. They should be putting pressure on Congress to cut the deficit spending, just like Volcker used to do. They're not doing it. Powell is hiding behind this phony claim of independent Fed means you can't criticize fiscal policy. You can't criticize deficit spending. He has enabled it. He has encouraged it, and not just him, but his predecessors. So yes, the Fed has been the big problem, but it takes two to tango. It's the Fed.
I'll let Professor Hanke close, and then we'll move on to another subject. Yeah, please go ahead.
Okay, now this is something you've kind of alluded to. That I want to another thing I want to clarify more than anything else. I'm in a clarifying mode here, and that is that the idea and the propaganda that was put out by the Fed and the White House and the Congress that non-monetary factors caused the inflation problem that we've gotten ourselves into.
Like oil, for example.
That Putin, oil, supply side shocks, all this rubbish. And it's pure rubbish. What caused it is the explosion in the money supply that went up at the peak 27% year over year in early 2021. We've never seen it that high before. And as night follows day, when the money supply explodes like that, with a long and variable lag, you get inflation. And that's exactly what John Greenwood and I predicted would happen.
Yeah, what compounded it, and I predicted it too, just like you did in real time, not only did they make the mistake of flooding the economy with money, they also told people to stop working, stay home, don't be productive. So the supply of goods and services to buy went down as the demand went up because we gave everybody money to buy stuff that nobody was producing.
Well,
and so it was even worse.
This is absolutely true now, and what is amazing with all of this, you read in the newspapers from the start of the pandemic when the money supply started going out of control to today, and Powell has done a brilliant job of sweeping all of these problems under the rug. He's gotten off, I think, scot-free. And the press never mentions anything about the money supply. All they prattle on and on about all these non-monetary factors. And the reason that the reason why inflation's getting better, it isn't because of the money supply contracting and getting under control. It's because the supply chains have been fixed. We have all that fixed now, and everybody takes this in. You cannot pick up any financial newspaper without seeing a rendition of all these non-monetary factors. So all these central bankers, all of them, not just Powell, have really gotten off the hook on this thing. They've conned the press into repeating.
Well, that's because the press is a propaganda machine for the government. The press wants to make sure the public doesn't realize that the source of inflation is the government, because the public is talking about how inflation is the big problem. Well, it's government that's the big problem because government causes it. I mean, I remember Gerald Ford, when he was president, declared inflation public enemy number one. But since the government causes inflation, then the government was public enemy number one. But also what helped bring down the CPI, I think, was the rise in the dollar. We had a big increase in the dollar on the anticipation of Fed rate hikes. That brought down commodity prices, especially energy prices, plus the dumping of oil from the Strategic Petroleum Reserve. So we had a big correction in commodity prices that took a lot of pressure off headline CPI. But if you look year to date, commodities are exploding, including oil. And I think the dollar is getting ready to roll over.
You got to stay, Peter, you got to stay with principles. On the commodity thing, first of all, I agree about the press. You got to check Hanke's 95% rule is 95% of what you read in the financial press is either wrong or irrelevant. But let's go to oil and these commodity prices. You've got that wrong too. Those are changes in relative prices. We have commodities and services. Those are two big sectors, and one is going up and one goes down, up, down, down. The general price level has been going up and then sinking and going down. And the best example I like to give about the oil, by the way, and this myth about oil prices causing inflation is Japan in the 1970s. We had two oil crises in the 1970s. And the first one in 73, the embargo in 1973, the Bank of Japan said, oh, oil prices are going up. And of course, they import all their oil in Japan.
Yeah.
And the Bank of Japan concluded, we have to accommodate that. So we'll increase the money supply. Well, inflation went up. And everybody said, oh, you see, oil prices caused inflation to go up. Then in 79, the second time we had a spike in the 70s with an oil crisis, the Bank of Japan says, no, we're not going to play ball this time. We're not going to artificially increase the money supply to accommodate this. And of course, they didn't have inflation. The oil prices went up relative to everything else, but the general price level never changed much in Japan.
Yeah, Professor, Professor, I'm a good student. I agree with everything you just said. You misunderstood my point. I'm not saying that rising oil prices cause inflation. They don't. But what they do is factor into the CPI, which measures inflation. So what I'm saying is one of the main reasons that the CPI went down from up 9% year over year to up 3% was because you had a pullback in commodity prices. And so that reflects in that. But the overall rise in oil and other commodity prices that is going to continue in 2024 and beyond is inflation. Inflation is what's causing commodity prices to rise, not the other way around.
You can't have it both ways.
I'm not having it both ways.
No, you are. Let me give you another lesson.
No, I'm not.
You are. You're absolutely wrong on this, and let me tell you why. You first have been arguing that non-monetary factors are nonsense and rubbish and don't cause inflation. And now you're arguing non-monetary factors like changes in commodity prices are causing inflation.
No, I'm not. I'm not arguing that at all. You're missing my point. It's the monetary expansion that caused oil prices to go up and commodity prices. I'm just saying that we had a temporary drop in oil prices and commodity prices as the dollar went up. All these goods, all these commodities are priced in dollars. So as the dollar went up, that brought down oil prices in dollars, that brought down commodity prices in dollars, that temporarily helped the CPI go down, right? But now those commodity prices are resuming their rise because of inflation. And so the impact they had on making the CPI look better is gone. It's in the rearview mirror.
Peter, I want to talk about economic growth.
See that. But the inflation is the money supply. I agree with you 100%. It's money and credit being expanded by the government. That's where all the excess demand is coming from.
Perfect. I want to talk about economic growth. Peter, isn't it possible that to fix the deficit problem, you just need to grow the economy faster, right? In theory, could we have an economic boom that could just by itself kind of rectify the deficit problem that we've been having?
Well, I mean, in theory, anything is possible, right? I mean,
is that your
AI,
view? Let me rephrase the question. Is that your view that we're going to get some? Yeah, there you go.
Yeah, I mean, look, we would have to have a tremendous increase in economic growth to bail us out of this problem. Of course, if we didn't have the problem, then the economic growth would be a much bigger windfall, right, for Americans. But is it possible that we can grow the economy so much that we can actually afford these massive deficits? I mean, maybe, but is it likely? Is it even a realistic possibility? I don't think so. And the debt at this point is just growing exponentially. That is the problem. And much higher interest rates are necessary than the rates we have right now.
Do you think we're going to get a recession, Peter? Still?
Excuse me?
Do you think we'll still get a recession next year?
Look, I believe we're in a recession. I just don't believe a lot of the numbers that we get from the government. I know that the Great Recession of 2008, it began in December of 2007, but they didn't officially acknowledge it until December of 2008, and they went back and they revised an entire year's worth of data to show that we had been in a recession for the entire year. And even up until mid-2008, most economists and Wall Street strategists didn't see a recession coming, even though we were in the middle of the Great Recession. So I think something similar could be going on. And I also think that the weakness in the economy, this stealth recession, is the reason that Biden and Harris are so unpopular. And if you look at these polls, where they score lowest is on the economy. And so how could they be blamed for a lousy economy if the economy is great, which is what the politicians are telling us and Wall Street and the bankers. But the public is telling us that it's not good, because if it was good, they would be crediting Biden. But they're not. They're blaming him because it's lousy. So I think we have recession. I think we have inflation, which means we're already in stagflation. I just think we have a lot of stag and a lot of inflation, despite the fact that Powell claims to see no evidence of either.
Okay, Professor Hanke, what's your view on whether or not we're going to get a recession and economic growth?
Well, I already said, due to the fact that we had this monetary contraction, and we've only had 4 like this in history, and they all led to recessions or depressions, we're going to have a slowdown and a recession. And it looks like now, Greenwood and I think this will probably be early in 2025. But on the growth potential thing, Again, if you read the press and you're reading quotations, people talking their own book from Silicon Valley about AI, increasing productivity and all this stuff, they actually think that the growth in the U.S. economy, the potential might go up to 6% per year. This is just total nonsense. This is not going to happen. The potential growth rate long run in the United States is about 2.2%, something like that. And if you look at the policies that we have, there are 5 pillars for prosperity. You've got to look at taxes. What's going to happen with taxes? Well, I think, unlike Peter, I think taxes are going up probably. So that's bad. That's going to hold back prosperity. Government restraints, that's restraint on government spending. That's probably not going to happen unless we get a constitutional amendment. So that's a negative. Monetary policy. Well, I think we have a problem because we have this big deficit that Peter and I are both worried about, and the CBO says is unsustainable. And one way to eliminate that unsustainable deficit is an inflation tax. So that means a monetary policy is going to be vulnerable to monetizing some of this. The fourth thing is regulation, and regulation's getting worse. More red tape, more red tape. That holds back the potential. And the last thing is international trade. And we've got more and more protectionism, more and more sanctions, and that's going to hold back competition, productivity, and potential growth. So if you look at the 5 pillars, taxes are probably going to get worse. Government spending is probably going to get worse. Monetary policy is probably not going to be fully corrected and not be helpful. Regulatory policies, more and more red tape, that's bad. And international trade, more protectionism. So if you look over the landscape of the 5 pillars, they're all pretty shaky. All right. Any way you cut it and mix them up, there's nothing in those 5 pillars. I don't think Peter would argue with me. I don't think there's anything in those 5 things that I said, Peter, that you think is going to get better.
Go ahead, Peter.
No, they're all going to get worse. I agree. Yes, they may get some tax increases that will mainly fall on higher income people, but those taxes will mainly diminish investment rather than consumption. So if you just raise taxes and the result is that wealthy people invest less in productivity enhancing capital, because they're not going to reduce their consumption. If you raise taxes on the millionaires and billionaires, they're not going to stop spending money on entertainment and food and travel. They're going to invest less. And that's not how you fight inflation, by diminishing investment capital. You have to go after consumption, and none of the politicians are going to do that. But what's the most problematic, and you'd have to agree, is that if you're right and I'm right, we do have a recession coming, whether it's a slowdown or an actual recession. We know how the government is going to respond. The minute we're officially in a recession, we're going to get stimulus. Regardless of where the inflation rate is, there's going to be some type of program to stimulate the economy. Government is going to increase spending even more with stimulus checks or some type of programs. The Fed's going to want to cut rates and do something because now we're in recession and unemployment is going up. But all this is happening with record budget deficits even before we juice them. And automatically, when you're in a recession, automatically the deficits get bigger because you have less tax revenue, you have more expenditures that automatically kick in, and you got this massive deficit's already there. So we've never gone into a recession in anywhere near the vulnerable fiscal position that we're in right now.
Let me just play a clip here from Jared Bernstein, chair of the Council of Economic Advisors.
A little comic relief.
Have you? Okay, you've seen this. I
don't know if that's sad or funny, or scary. I don't think Professor
Hanke has seen this, because I think you're both talking about what the government will do, and I don't know if people, we should take a look at this clip and see what the government actually is thinking about right now.
Like you said, they print the dollar. So why does the government even borrow?
Well, again, some of this stuff gets some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah. So a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to, I guess I can't really talk. I don't get it. I don't know what they're talking about. Like, cause it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing there.
I want to get Professor Hanke's reaction to that. Well, Peter's already seen it.
He's talking. He uses the acronym MMT. That's modern monetary theory, and basically, if you boil all of it down, the mumbo jumbo and everything, modern monetary theory simply says that deficits don't matter. Now, Peter and I we might disagree on all kinds of nuances and so forth, but we agree on one big thing: deficits do matter.
All right, I want to finish off.
Now, one thing Peter said that he said it two different times, and that is that we had to have, if we had a consumption tax. Now, when we were talking about increasing taxes, and let me just say that they have a consumption tax in Europe. Generally, it's called VAT, the value added tax. In my view, that's the stupidest tax, and so these consumption taxes that you could possibly dream up. And that is one reason, and one big reason, by the way, that Europe is lagging way behind the United States, is because of the VAT tax. So
I think it's that. Well, they also have an income tax.
The five pillars of prosperity are nothing more than Reaganomics. And of course, I know a little bit about this because I was on Reagan's Council of Economic Advisors. And the five pillars are Reaganomics. Taxes. Do you have good taxes? Government restraint, monetary stability, regulation and deregulation, international trade, free trade versus protectionism. So I am not a consumption tax fan at all, or a VAT thing.
Well, the main reason that I think a lot of European nations are lagging is not because they have a VAT, it's because they also have an income tax, and they also have a big social welfare system and a lot of regulations. Now, yeah, I would prefer a sales tax to a VAT because it's more transparent, but that's why governments like VATs, because it's not as obvious how high the cost is. But I would much rather run an economy on a consumption tax than a tax on work and production and income. That's not the way to do it, and it's a much fairer, easier tax system to comply with. You don't have to keep books and records. You don't have to, have all these loopholes and various ways to try to get around the tax. That's the type of tax system that the founding fathers envisioned. That's why they made the requirement to apportion direct taxes. The U.S. government was supposed to run on excise taxes, not direct taxes. But my point was that if we raise taxes and just do it on incomes, it's going to be counterproductive economically. We need to. I would rather not raise taxes at all. I would rather slash government spending. This is reality.
You're preaching to the choir here. I was one of the original supply siders, so you don't have to tell me about the.
All right.
Negative and spending effects.
So we probably agree on that.
Taxing income.
I'd like to finish off on.
But let me make one point. That you played that Bernstein clip. He didn't answer the question because he doesn't know how to answer it, and he's not even sure what a loan is versus borrowing. First he said the government was lending money. No, it was borrowing money. It was when it sells bonds. But he didn't answer the question as to why we don't just print money. Why do we even borrow? Well, because when we borrow money, we're borrowing money that already exists. It's not inflationary in and of itself. we can take money out of the economy and put it back in. But when the government just prints money, that's inflation. So yes, you can run the government and without it borrowing money. In fact, you can get rid of all legitimate taxes. We don't have to have an income tax. We don't have to have a sales tax. The government can just print all the money it needs and just spends it. But that doesn't mean we get government for free. All that means is we're going to pay much higher prices for everything we buy. We're going to pay for government through inflation, through higher prices, rather than through taxation. So that is how he should have answered the question. The reason we borrow is so we don't have inflation.
He clearly doesn't understand how the money supply as measured by M2 actually exists. The government it's a small player in printing money. 11%.
Well, of course, the Fed.
11%. 11% of M2 is made up of notes and coins. 76% is made up by liquid deposits at commercial banks. Commercial banks are the elephant in the room. They produce most of the money is produced by commercial banks, and then you have a little bit that's
right. But
made
the
up
Fed is the enabler there.
Okay. What?
Well, the Fed enables that, though.
Let's just finish off on
and the deposit insurance, the government deposit insurance, the FDIC.
There's a whole mass of regulatory structure that governs banking. And the Fed is just one small part of that, but there are many aspects, and most people don't understand monetary policy is actually something that's put in place by many actors in Washington besides the Fed. Everybody who regulates the commercial banking system is involved in fact, monetary policy.
Yeah, and that's why the commercial banking system is basically insolvent. It's because of government mismanagement and manipulation. We're just, one crisis away from a complete implosion in the banks, because the banks, thanks to the government and thanks to deposit insurance, they're loaded up on long-term debt that yields 2%, 3%, 4%. And to the extent that the Fed actually has to raise interest rates to a realistic level, all these banks fail. I mean, they're sitting here with a mountain of bad debt that they're not marking to the market because they're pretending they can hold it all to maturity. But they may not be able to do that.
Are we getting a banking crisis? That was my next question, Professor Hanke. Are we getting a banking crisis? Can you address Peter's point?
Are we going to see a banking crisis?
Yeah. Is there another one unfolding, a bigger one?
Again, I'm not in that kind of crystal ball zone. I can tell you where the economy is going. It's going to slow down. We're going to have a recession. Do some banks get into trouble, and some financial institutions as well as individuals, when that happens? And the answer is yes.
Okay, Peter, what's your outlook on? We'll finish off here. What's your outlook on the dollar, interest rates, and gold, given your economic outlook?
Well, I think that regardless of what the Fed does, they should be hiking rates. They're more likely to reduce them somewhat. But I think regardless, long-term interest rates are going higher. Bond yields will move up because I do believe the dollar is going to roll over. And I think the selling pressure on treasuries is going to continue to mount, not only from the government trust funds, which are now big sellers like Social Security. They have to sell treasuries because they don't collect enough taxes to cover the cost. But I think you're going to see a bigger exodus of central banks, particularly in the emerging markets, the BRIC nations. I think they're going to accelerate their gold buying. In fact, as the price of gold moves higher and higher, they're going to have to spend more dollars to buy that gold. They have a lot of dollars on their books to get rid of and to replace with gold. So I think you're going to continue to see gold prices rise. At some point, investors are going to start buying gold too, competing with these central banks. So I think the trajectory of the increase is going to accelerate. And that's, the canary in the coal mine for the dollar. I think, gold is the main competitor to the dollar as a reserve asset. And as gold prices really start to rise, you're basically seeing the gold value of your dollar reserves plunge. That's going to put more pressure to de-dollarize. It's already there based on the sanctions, too, that we put on Russia. You have a political motivation, not just an economic motivation, to reduce your reliance and dependence on the U.S. dollar. So I think the dollar is going down. I think bond yields are rising. I think the price of gold is going up. And this is also going to be very problematic for the U.S. economy because higher interest rates and higher inflation are going to be a big problem that are going to exacerbate the severity of the next recession, which, of course, the Fed is going to try to fight by going back to its monetary playbook of creating more inflation. Because you have to understand, the way the Fed fights recession is by creating inflation. That's what it does. It creates inflation. But when you have an inflationary recession, when inflation is the cause of the recession, how are you going to fix that, with more inflation? It's not going to work. It's going to backfire.
For sure. Professor Hanke, can you address the de-dollarization issue that Peter brought up? Is the dollar in trouble for the reasons that he stated?
Well, it's very close to its all-time high on the weighted average. It's been very strong for quite some time. So we again, if you read the press and listen to what's in the press, all they talk about is de-dollarization and the fact that the reserve status of the dollar has been shrinking, which it has, by the way. But the dollar remains up at the all-time high right now. And I don't see any change in the near future for that. As far as gold, as you know, I've been a gold bull for a long time. And it's going up. And Peter mentioned the central bank buying, and that part of that is a de-dollarization story. But the real story is retail buying in China. This is all a China story. The gold going up. It's not really a central bank story. It's really what is the cutting edge here? It is not non-Chinese retail, non-Chinese, non-central bank buying. That's actually gone down. The retail buying at the non-Chinese, non-central bank level is muted now. It's if anything slightly on the weak side, neutral to slightly weak. But the Chinese buying on the retail non-central bank side has been extremely strong, and I think it will continue. As far as
the Chinese are smart. They're ahead of the curve.
They might be, but on the bond yields, I don't agree with what Peter's conclusion is that bond yields will be going up. They'll be going down because bond yields, long-term bond yields, always follow inflation, and inflation's coming down, not up. Peter says it's going up, it's going down, and when I'm saying that, I'm saying we know that for, let's say, through 2025, because of what has happened before with the money supply. These changes in the money supply cause things to change with long and variable lags, like inflation, and that's baked in the cake. I already know that's happening. This isn't a crystal ball thing. It's almost.
But what's also baked in the cake is that they're going to start, gunning the money supply again. I mean, that's this decline is temporary.
And then in a couple years, you might, if they did what you just said, then you would have more inflation in a couple years out. I said, I'm very precise here, Peter. I said 2025. That's what's baked in the cake. Beyond that, we don't know, because we don't know what's going to be happening to the money supply in the next quarter, next half a year or so forth. That will determine what's going to happen.
I think that, as the economy weakens, they're going to have to go back to QE. But in the meantime, you talk about the strong dollar. It's weak. It's just less weak than the euro and the pound and the yen. You're just measuring it relative to another fiat currency. But if you look at it relative to purchasing power here in the United States, if you look at the dollar relative to how much gold you can buy, the dollar is weak. The dollar is going down. But so is the euro. So is the pound. So is the yen.
It depends on how you measure it. I'm just measuring it in a conventional way, looking at all the currencies in the world.
Yes, they're all weak.
It is the king, and it is within 5% of its all-time
It's about
high.
to be dethroned. That's what I think. I think its reign is coming to an end.
Well, you're a de-dollarizer. You're in that. You're repeating what you read in the press.
No, I'm not reading the press. I'm saying this on my own. I don't pay attention to what's
let me help you because I read the press very carefully, as anyone investing should be doing. Even though 95% of what you read in the press is either wrong or irrelevant,
as a contrarian indicator,
the 5% can be extremely valuable if you know what you're doing. And I'm just saying that you're echoing what's in the press.
Okay,
I think the press is echoing me.
Let's finish it. Maybe they're reading Peter Schiff. Let me finish off on one final point. I think something you both agree on, Peter. Isn't the dollar going to get dethroned by Bitcoin? I mean, per your argument, Bitcoin's outperformed everything as a currency. Why aren't you? Are you buying Bitcoin? I haven't asked you in a year.
Well, you know, Bitcoin is a non-event. It's a sideshow. I mean, it's important to the people who have bought it, and they're going to end up losing a lot of money if they don't sell it. But somebody's got to get caught holding the bag because somebody's going to own it when the music stops. But I think it's a sideshow. I think it's completely irrelevant to what's going to happen. I mean, central banks are not going to buy it. It's not going to replace gold or let alone it's not going to replace any of these fiat currencies, let alone replace gold.
We're talking about a sideshow that occurs in some place like Las Vegas. As I've said since day one, Bitcoin is a highly speculative asset with zero fundamental value.
Yeah, okay. We agree 100%.
All right, I end of discussion there, I guess. Okay, thank you both, gentlemen, for a very thorough discussion. Where can we follow your work, Peter?
Well, you can follow me on on social media. I do my own podcast, The Peter Schiff Show. It's on schiffradio.com, on my YouTube channel. You can follow me on X. Now I have over 1 million followers, so I do a lot of posting there. I do my own posts. If you're interested, we both agree on gold. Call my representatives at Schiff Gold. You go to schiffgold.com. That's my gold company. And if you have a larger portfolio that you'd like me to manage, you can see above my shoulder. That's the website for my asset management company, where we manage 5 mutual funds as well as individual portfolios. I think it's important that people prepare for what's to come and recognize that the dynamics that have been at play for the last decade or so are changing dramatically. And you can't invest, the way it worked in the past, kind of like in the 1960s, you had the Nifty 50, but if you stuck with that portfolio, you got slaughtered in the 1970s. And I think the same thing is going to happen to most investors in the coming decade. So you got to make the type of switch that we've made already at Euro Pacific Asset Management.
All right, Professor Hanke, thank you very much. Where can we follow your work?
Well, going to X, I'm not quite up over 1 million. I've got 730,000 followers, but you can follow me on X at Steve_Hanke. That'll get me on X. And if you want my irregular distributions of materials, articles, and whatnot, you just send me an email at hanke@jhu.edu.
All right. We'll put the links for both Professor Hanke and Peter Schiff in the links below. So make sure to check both of them out. Thank you very much, gentlemen, for both of your times. We will speak again soon. Thank you.
Hey, great. Thanks.